The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are.
Warren Buffett shares his best 8 investing advice to build real wealth. In this video, I've compiled 8 golden tips from Warren Buffett, the world's 6th richest man, a self-made billionaire and legendary investor, that will teach you how to invest step by step. If you're feeling lost in the world of investing or don't know where to start, this video is exactly what you need. Watch until the end, and you'll clearly understand what you should and shouldn't do when it comes to investing, based on the timeless principles Buffett has followed for decades. If you're ready, let's dive into 8 powerful Warren Buffett tips that will help turn you into a confident investor. Invest in what you understand. Never invest in a business you cannot understand. Buffett sticks to his circle of competence, areas he deeply understands. It's not about being smart in every field, but knowing your limits and avoiding blind risks. When you understand a business, you can estimate its value, judge its risks, and hold through volatility. When you don't, you'll panic or get misled by hype. Simplicity and clarity give you confidence, and confidence helps you stay the course. Buffett didn't invest in Amazon or Google early on, not because they weren't promising, but because he didn't understand how to value them.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
Instead, he chose Coca-Cola, where the product, cost structure, and competitive advantage were crystal clear. This made it easier to hold the stock long-term. Focus on the long term. Our favorite holding period is forever. True wealth comes from letting compounding work. Great businesses grow earnings year after year, and the value follows. Short-term trading turns investing into speculation. Short-term moves are driven by emotions and news, but long-term gains come from business performance. Staying invested reduces stress, lowers taxes, and maximizes compounding. Buffett has held Coca-Cola for over 35 years. His initial $1.3 billion investment has returned billions in dividends and capital gains. The lesson: choose companies you can confidently hold through recessions and booms. Buy wonderful companies at fair prices. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. A great company will keep growing, even if you slightly overpay. But a mediocre one can stagnate or fail, no matter how cheap it looks. Quality compounds better than bargains. Look for companies with durable competitive advantages, brand loyalty, pricing power, strong management, and predictable cash flows. Don't get lured into low prices without long-term value. Buffett bought Apple not as a tech bet, but because it had loyal users, high margins, and a razor and blade business model. He paid a reasonable price, and it became Berkshire's #1 holding. Be fearful when others are greedy, and greedy when others are fearful.
Temperament that when others are fearful, you're going to get scared yourself. You know, you are not going to make a lot of money in securities over time in all probability. People really, if they didn't look at quotations, but of course the whole world is urging them to look at quotations, and more than that, do something based on small changes in quotations. But if you didn't, think how much more rational, we've talked about it before, but think how much more rational investing in a farm is than the way many people buy stocks. I mean, if you buy a farm, do you get a quote next week? Do you get a quote next month? If you buy an apartment house, do you get a quote next week or month? No, you look at the apartment house or the farm and you say, I expected it to produce so many bushels of soybeans and corn, and if it does that, it meets my expectations. But they buy a stock and they think if it goes up, it's wonderful, and if it goes down, it's bad. We think just the opposite. When it goes down, we love it because we'll buy more, and if it goes up, it kills us.
Opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Market crashes are not threats. They're opportunities to buy great assets at a discount. Conversely, during bubbles, inflated prices hide risk. Emotions drive markets in the short term. Fear creates undervaluation. Greed causes bubbles. Buffett trains himself to go against the crowd and profit from it. In the 2008 crisis, when panic ruled, Buffett invested in Goldman Sachs and Bank of America, structuring deals with high dividends and equity upside. When recovery came, he made billions. While others were scared, he bought value. Keep it simple. The stock market is designed to transfer money from the active to the patient. Most people lose money trying to be clever. Complexity doesn't equal success. Time, discipline, and basic strategy usually outperform sophisticated guessing games. Buffett recommends low-cost index funds for most people. If you can't identify and value businesses, buy the market. Simple beats smart when emotion enters the game. Instructing that 90% of his wealth go into an S&P 500 index fund after he passes away shows his belief in simplicity. That's Buffett trusting the market long-term more than any short-term manager. Don't try to time the market.
We have never, I don't think we've ever made a decision where either one of us has either said or been thinking we should buy or sell based on what the market is going to do.
No.
Or for that matter, on what the economy is going to do. We don't know.
The only value of stock forecasters is to make fortune tellers look good. Nobody knows when the market will peak or crash. Not economists, not hedge funds. Timing the market is a loser's game. Instead, focus on the value of what you're buying. Waiting for the perfect moment often means missing good ones. Being consistently invested in good assets beats being occasionally perfect. Let the businesses grow, and let time do its work. From 2009 to 2020, many sat out of the bull market waiting for a correction. Buffett, however, focused on buying undervalued businesses and ignored forecasts. He made money while others waited on the sidelines. Invest in yourself first. The most important investment you can make is in yourself. No investment yields better returns than improving your knowledge, confidence, and habits. The more capable you become, the more opportunities you'll recognize and handle well. Education improves your judgment. Health boosts your energy. Communication strengthens your leadership. All these pay dividends in every area of life, including investing. Buffett once said, the best investment he made was a Dale Carnegie public speaking course. It helped him overcome fear, build trust, and lead effectively. Skills that shaped his success far more than any single stock. Avoid debt, especially to invest. If you're smart, you don't need it. If you're dumb, you shouldn't be using it. Debt adds risk, and risk multiplies in a crisis. When you're leveraged, you're forced to sell under pressure. That ruins compounding and exposes you to ruin. Use debt wisely in life, but avoid it in investing, especially margin debt. Cash reserves provide safety, flexibility, and opportunity when others are desperate to sell. Berkshire Hathaway keeps billions in cash and rarely uses debt. In downturns, this allows Buffett to buy when others are forced to sell. In contrast, many investors wiped out in 2008 or 2020 had borrowed too much. In the end, these are Warren Buffett's most valuable investing principles that can help you make smarter financial decisions, build lasting wealth, and avoid common mistakes that hold most people back from achieving true financial independence. Thank you for watching my video. Before you go, make sure to subscribe and leave a like if you want more videos like this. Goodbye.